Hey everyone, I am Jack Routledge. I am a former banker, mutual fund salesperson, and loans officer. I'm here to talk to you today about money in the way that I like to. No BS, what the banks don't want you to hear, all that jazz. Go ahead and like, comment, and subscribe in this video, turn on notifications, as well as follow me on Instagram and TikTok. I try to post clips there every day, just random thoughts that come to my head, so it's a great place to keep up with what I'm thinking about. Today, we're going to talk about why you shouldn't buy a rental. This is a little bit contrary to advice that would have been very popular a year or two ago. Now this might be a bit more of a common sentiment, but we'll run through a few scenarios, talk about how much work it actually takes to manage rental properties, and what you could do to avoid that, or if you may be the right person to buy them. Let's get into it. So the fundamental problem with rentals is that people don't think that they are as much work as they actually are. Years of great economic growth in the industry have made people think that rental properties are just these endless money printers that require no hands-on. You just buy one and then money just comes into your account. But that's definitely far from the truth. There's a lot that goes into working on a rental property and making it actually produce money for you. So while they do create good cash flows and you are pretty likely to get a capital gain when you eventually sell your asset, you can very quickly become bankrupt as an unprepared buyer when looking at investment properties. So how do you properly buy a rental then? Well, if there's one thing that I would like you to take away from any of these videos that I ever make, if there's one thing that you can say that you learned from Jack Routledge specifically, it's be ready for whatever you are taking on. So being able to have the proper down payment, know your loan terms, how you're going to make money, everything like that is extremely important to have sorted out ahead of time before you pick up your first rental. Basically, most rentals, if you're doing them correctly, require a commercial mortgage from the bank if it's not an owner-occupied property. So with a commercial property, you need to have at least 20% down on the mortgage that you're taking out, and usually the banks will require either a rental market report or cash flow statement, something like that, to reassure that you are going to pay. Commercial mortgages are a lot harder to for the bank to make their money back if you were to be foreclosed on, and because you're being foreclosed on, they don't want to be a landlord as well. So the bank has to make sure that you're not going to screw them over. They want to keep their money and they don't want your property. So let's take a look at a basic Big 5 in Canada commercial mortgage. We'll say the property we're looking at today is $500,000. So with that, you're not able to do a high ratio mortgage on a commercial property. So when we're taking a look at our mortgage, it's going to be 20% down. So on a $500,000 mortgage, $500,000, that's $100,000 that we have to have for a down payment. This money also needs to come from an approved source as per our money laundering regulations here in Canada as well. So it either needs to have 3 months of bank statements to prove if it's your money on deposit. If it's a gift, you'll need a gift letter from the individual that you're getting it from, that it doesn't need to be paid back. And they may also need to provide statements for that as well. And then the other way that you can get a down payment is by using equity from an existing property. So the biggest thing there is making sure that this doesn't affect your TDSR too negatively, taking out a big chunk of probably a secured credit line against your house or something like that, as well as making sure the carrying cost of the debt doesn't affect your ability to make profit or loss on the property. Usually this is not necessarily something we think about. We think, oh, we have a $1,500 mortgage, we'll make $2,000 in rent, and then we are good. To get that $2,000 in cash flow, it may cost you, $250, $350 a month, and now all of a sudden what felt like a decently profitable venture is now almost nothing. So that's something to keep in mind. So say we took the $100,000 from a real estate secured lending facility, we have 4.5%. That's going to cost you $375 a month in interest-only payments on there. So again, it's not a ton, but it's definitely more than what you're anticipating if you were able to put down cash. That's going to affect your cash flow on the property. And like I said, if the down payment is a gift from a family member, you're going to need a gift letter. And with gift letters, like I say, they may need to provide statements proving the money's origination as well. And gifts can only come from certain individuals. You can't have your buddy Jim or your business partner give you a gift to buy a property. That's not how it works. It usually has to be a family member or something like that. Rates are also generally higher as well. Right now, a local credit union to me is offering 6.69% over 5 years on a commercial mortgage. Just use the credit union because they're easier to get numbers just for a quick reference than it is to get from the big banks. Usually that's all tied to credit approvals and stuff. So with a local credit union, 6.69%, which is probably a little bit higher than residential mortgage rates, although I'm a little bit behind exactly on those quotes because I'm not in the bank anymore. It's hard to get rates. So the rental requires 20% down, has a higher rate than your current home mortgage, but there's some other costs as well that you need to think about. So you've got your 20% down, you're ready to pay the higher rate, but there's a few other costs that you need to think about that you may not have on a traditional home mortgage. So obviously you're going to need float cash for repairs, security deposits, things like that. If you're only putting 20% down, it's going to be quite a while until you've got accessible equity as a secured credit line on your property as well. So you're going to need some cash set aside for that. Plus, generally, commercial mortgages are more expensive. Appraisals cost more money. There's just more general costs of getting the mortgage. The bank might need a rental market report, something like that, to underwrite your mortgage. So it may take more due diligence than you think it does to get that mortgage. Now, this is a little bit of a guess, but I would feel comfortable saying you probably want another 5% of the purchase price of the building for closing costs. So another $25,000 for, again, all of those repairs, repainting, mortgage costs, everything like that. Not necessarily traditional closing costs, but everything you're probably going to want to do regarding the property in the first year, say that you own it. So say another 5%. So now we're $125,000 in cash that we have to scrounge up to buy our $500,000 property. If we use debt to raise that $125,000, we're probably fairly aggressively leveraged at this point. With leveraging as well, we have to remember that it compounds both losses and gains. So if you're doing well, your investments are going to be multiplied. But if you're taking a loss, you're still going to owe that mortgage payment regardless of how well your investment is doing. You can definitely use debt to make investments, but you have to be mindful of the cost of that and the effects it can have. So then obviously, and this might sound pretty obvious, but the other biggest thing that comes with success of a rental is your ability to get really good tenants. Having high quality tenants, they're hard to find, and once you have them, you want to keep them. So you're going to want to treat them well as well. You're going to want to be quick on repairs. You're going to want to be attentive, pay attention to their needs and their wants, and do what you can to make them stick around, because they're worth a lot more than just the rent they pay you. So our $400,000 mortgage is going to cost us $2,725.54 per month for the mortgage payment. You're probably going to pay for the water. Your tenants are probably going to pay for hydro and internet. I'm assuming this is a multifamily building. So if we use 5% of the value of the building as our rental target, how much money we're wanting to make per year in revenue, then we're going to need to make $25,000 a year split over 4 units in our multifamily building that we're looking at here. That's about $520 a month you need to generate in rental revenue per unit for that building. And now that seems nice, but that doesn't actually cover our mortgage payment, let alone the other costs we've incurred, our down payment, our other costs of improvement and everything like that going forward. So we need to still think about how we're going to actually make money with that rental property. It's generating cash, but not enough cash. But realistically, in my area, a 4-unit building would rent for anywhere from $800 to $1,000 per unit in the building. So that brings us $38,400 per year in rental revenue. Just based on our mortgage costs over a year, we're able to make a gross profit of $5,693.52 per year on that property. Now, out of that $5,700, just short of, we still have to pay property taxes. We still have to set aside money for improvements. We still have other expenses. Plus, we still have to pay ourselves. Managing a property is a full-time job in some cases, so you will want to obviously pay yourself at some point too. Now, there's tax benefits, long-term appreciation I haven't figured in. These are just rough numbers to give you an idea that it's not just as simple as buy investment property, print money. Rentals in Canada have yielded 3.91% returns according to globalpropertyguide.com. So 3.91, I mean, there's GICs that are outpacing that right now in rental returns. So definitely something to take into thought into 2022, 23 now, is whether that generated cash flow is actually worth as much as it seems like. So just keep that in mind as well. There's a lot of investments, fixed term ones, that are doing better than rentals are at this moment. Basically, ton of information, planning, math that goes into buying a rental property. I still think that Dave Ramsey has it pretty correct on the rental properties. He says buy in cash. I say put as much cash down as possible. If you own a building outright, now all of a sudden your mortgage coverage is not something you need to worry about, and you are making massive money. That's when a rental property becomes a money printer. If you're making that $38,400 a year with no expenses besides just your general maintenance on the building, your variable costs, no fixed costs. If you have 2 or 3 of those, well, now all of a sudden you're making $160,000, $170,000 a year with minimal costs, and you're actually able to pay yourself and enjoy the properties and have some time off to live your life. So cash is king in rentals. Pay cash if you can. So the next thing is who the ideal owner is. So obviously, if you're going to own a rental property, this will sound dumb, but the ideal owner is someone who wants to own a rental property. So again, it's not just this buy, print money, go retire and live the life of the bourgeoisie. It requires work and effort to be a landlord. It's an active asset. You need to be finding tenants when your unit is empty. You need to care for the place. It requires cleaning in between. You got to go to the bank every month. You got to do your books, everything like that. It is a decent amount of work to manage. You could also pay a property management company, but those will charge anywhere from 10 to 15% of either the rental revenue or the cost of the building in management fees. So that might negate any return or profit that you might have had at that point. You probably want to be a fairly handy person as well, being able to paint walls, hang doors, fix trim boards, things like that. When you're having to pay a contractor $80, $90, $100 an hour to fix those little things, that's going to add up very quickly compared to if you have some DIY skill. And then finally, you got to be able to deal with people. Unfortunately, it's going to be your phone that rings at 2 in the morning when the toilet is backed up and it's flooding in the bathroom. You're going to have to go address that. So just keep that in mind. You are now somebody's landlord. So like I say, the house is yours. You need to address problems, and if they're drastic, you need to address them whenever they come up. You can't just say, I'll get to it next week. You shouldn't. That's what a bad landlord does, and that's what gives landlords a bad rap. Don't do that. So then, if what I talked about sounds like a lot, it is, and if it does sound like a lot, then don't buy a rental. There's other assets you can buy. ETFs, mutual funds, stocks, bonds, GICs, pretty much anything is going to be just as good as a rental when you take out that hands-on part of the return. So, a rental may generate more return as a pure number, but you have to factor your time into that return as well and the effort it took to do that. But if it sounds interesting, definitely go buy a rental. You won't regret it, I don't think. There's still a great market, especially if you have cash to put down. Things are getting a little bit cheaper right now, so it's something to look forward to. Thanks for watching. Like, comment, subscribe, and check out the next video when it's uploaded. We'll see you soon.